Are you looking for a way to grow your money and secure your future? Investing could be the answer. It's not just about saving, it's about making your money work for you. In this video, we'll explore how investing can help you achieve your financial goals. Don't forget to like and subscribe. Why should you invest? Investing is a great way to grow your money and secure your future. In today's world, just relying on savings accounts with low interest isn't enough to keep up with rising prices and inflation. If you're not investing, your money isn't working as hard for you as it could be. Saving is important, but it's not enough to make sure you're financially set for the future. As prices go up over time, the value of cash goes down. This means that money left in a savings account or tucked away at home loses its value every year, making it harder to afford things. That's where investing comes in. By putting your money into things that grow over time, like stocks or real estate, you can protect yourself from inflation and increase your wealth. The impact of inflation. Inflation is when the prices of things we buy, like food or gas, go up over time. This means the value of your money decreases because you can't buy as much with the same amount. Over the last 60 years, inflation has averaged about 3.8% per year. So if your money isn't growing faster than inflation, you're losing money. For example, if you have $1,000 in a savings account that earns only 1% interest, it might seem like you're making money. But after a year, because of inflation, that $1,000 will only be worth $961 in what you can buy with it. To make your money work for you, investing is key. By putting your money in things like stocks, real estate, or bonds, you can earn more than inflation and help your money grow instead of losing value. How can you make money from investments? When it comes to investing, there are two main ways to make money: capital gains and dividends. These are key to understanding how investments can grow your wealth over time. Capital gains happen when you buy an asset, like a stock or real estate, and sell it for a higher price than what you paid. For example, if you buy a stock for $100 and sell it later for $150, you make a $50 profit. The trick to making money this way is timing the market well and thinking long-term, so your investments can grow in value over time. Dividends, on the other hand, are payments that some companies give to their shareholders from their profits. These are usually paid out quarterly or annually. If you own stock in a company that pays dividends, you might receive a certain amount per share every few months. This can give you a steady stream of income without having to sell your investments, and you can use those payments to reinvest and grow your wealth even more. Both capital gains and dividends are powerful ways to generate wealth. When combined with the power of compounding, they can help your money grow much faster over time. Power of compound interest. One of the most powerful concepts in investing is compound interest. It's the idea that your investment earnings start to earn their own earnings over time. In other words, you don't just earn interest on your original investment, but also on the interest that you've already earned. This snowball effect can really speed up the growth of your wealth, especially if you keep investing consistently over many years. Here's a simple example to show how powerful compound interest can be. Let's say you invest $250 each month in a portfolio that gives you an 8% annual return. After 42 years, even though you only invested $250 a month, you would have over $1 million. And if you kept investing for 10 more years, that total would grow to over $2 million. This is the magic of compounding. It helps your money grow faster and faster over time. Of course, the stock market can go up and down, and there's no guarantee of returns. But history shows that long-term investments in things like the S&P 500 have given about 10% returns on average each year. By sticking with your investments, even when the market is unstable, and reinvesting any earnings, your wealth can grow over time. The importance of starting early. One of the most important things to remember when it comes to investing is time. The earlier you start, the more time your money has to grow through compound interest. That's why it's often said that the best time to start investing is right now. Even if you only have a small amount of money to begin with, starting early gives your money more time to work for you. Let's take an example. If you start investing at age 25 and put in $200 $250 each month for 40 years, with an average return of 8%, you could end up a millionaire by the time you retire. But if you wait until age 35 to start, you'd need to invest much more each month to reach the same goal. Starting early gives you the advantage of compound interest, which means you can invest small amounts over a longer time and still end up with a bigger result. Types of investments to consider. There are many ways to invest and grow your wealth, each with its own risks and rewards. Here are some popular options to consider. Stocks. When you buy stocks, you're buying a small part of a company. As the company grows, so can the value of your stocks. Stocks can go up and down in value, but over the long run, they often provide good returns. If you're just starting, consider buying index funds or exchange-traded funds, ETFs, that track the overall market instead of picking individual stocks. Bonds. Bonds are like loans that you give to companies or governments in exchange for interest payments. They are less risky than stocks, but they usually provide lower returns. Bonds can be a good choice if you want a steady income without taking too much risk. Real estate. Real estate involves buying properties that can either increase in value over time or provide rental income. While it can be more hands-on, real estate can offer great returns, especially in growing areas. Mutual funds and ETFs. These are groups of investments like stocks and bonds. Mutual funds are managed by experts, while ETFs usually track a specific market index. Both options allow you to invest in a variety of assets, which can help spread out risk. Cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum have become popular in recent years. While they can offer big rewards, they are also very risky and can be highly unpredictable. Precious metals. Gold, silver, and other precious metals are often used as a way to protect your wealth from inflation and economic uncertainty. They tend to keep their value when markets are unstable, making them a good option for diversifying your investments. Risk and diversification. All investments come with some level of risk, which means there's a chance your investments may not do as well as you hope, and you could lose money. But the good news is you can manage that risk. One of the best ways to do this is through diversification. This means spreading your money across different types of investments, industries, and even countries. Diversifying helps lower the overall risk in your portfolio. For example, instead of putting all your money into one stock, you can invest in different companies, bonds, real estate, or even international stocks. By doing this, you reduce the chance of losing a lot of money if one of your investments doesn't perform well. It's a smart way to make sure you're not too dependent on any one investment. How much should you invest? How much you should invest depends on your financial goals, how much risk you're comfortable with, and your current financial situation. A good starting point is to aim to invest at least 10 to 15% of your income in the future. Even if you're just getting started, putting away small amounts can grow a lot over time, thanks to compound interest. Many experts suggest setting aside an emergency fund before you start investing. This should cover 3 to 6 months worth of living expenses, so you're prepared for any unexpected costs. Once you have that safety net, you can feel more confident about putting extra money into your investments. So, are you ready to start investing and take control of your financial future? Remember, the key is to start early, stay consistent, and be patient. Every small step you take now can lead to big rewards later. What's holding you back from investing today? Don't forget to like, share, and subscribe for more tips on building your wealth.